Welcome back, everyone. Today, we're going to be diving into the world of dividend-paying stocks.
Oh, yeah.
Yeah, those companies that share a portion of their profits with investors, like you.
Like us.
Exactly.
Yeah.
And we've got an article here focusing on 5 specific companies, plus a few ETFs.
Oh,
So, yeah, buckle up, because we're going to be uncovering how you can potentially build wealth with dividends.
oh,
Yeah. So what's really intriguing about dividends is that they offer like a two-pronged approach to investing.
yeah, it's true.
You're not just hoping that the stock price goes up, but you're also getting a regular stream of income
Right.
just for owning those stocks.
Yeah, you're getting paid to be an owner.
Exactly. It's
Yeah.
like getting a little bonus for being part of the company's success.
Exactly.
Now, the article mentions something about dividend payers outperforming non-payers over the long haul, almost like a secret weapon for investors.
Well, yeah, the Hartford Fund study looked at returns from 1973 to 2023.
Whoa.
So a pretty significant time frame.
Yeah.
And guess what? Companies that consistently grew their dividends or started paying them saw an average annual return of over 10%.
Wow.
Now compare that to non-payers who only saw around 4%.
Okay.
So that's a difference of almost 6% per year.
It's a big difference.
It is.
Almost like choosing the tortoise over the hare.
Yeah.
Slow and steady wins the race, right?
Exactly. And think about it. A company isn't going to commit to sharing those profits unless they're pretty confident about their future,
Yeah.
their stability and their ability to keep making money. So those consistent dividends can actually be a sign of a company's overall financial health.
Makes sense. So it's not just about the immediate payout, but also what that dividend signals about the company itself.
Right.
It's like a vote of confidence from the company saying, hey, we're doing well,
Yeah,
and we want to share this success with you.
for sure.
So the article highlights 5 companies that have caught your eye.
Okay.
And it's a pretty diverse mix.
Interesting.
We've got Altria, the tobacco giant,
Mm-hmm.
Chevron in the energy sector. Then there's Verizon for our communication needs,
Right.
AbbVie representing pharmaceuticals,
Uh-huh.
and lastly, Realty Income, a REIT focused on real estate.
It's fascinating how many different types of companies offer dividends.
I know, right?
From everyday things we rely on, like our phones and internet, to more specialized sectors like pharmaceuticals and real estate. It's like something for everyone.
Yeah. It's like building a portfolio based on your daily routine.
Uh-huh, yeah.
Speaking of which, let's start with Altria.
Okay.
They're facing some challenges with declining smoking rates, but they still offer a whopping 8.2% dividend yield.
Wow.
I know, right?
That's pretty tempting.
But as an investor, you have to wonder, is their move into vaping products enough to make up for those shrinking cigarette sales?
Yeah.
Will that high yield be sustainable in the long run?
Those are exactly the right questions to be asking.
Yeah.
While a high yield is attractive, it's crucial to look at the bigger picture.
Right.
Altria has been consistently increasing its payout for over 50 years, which is impressive, but their 5-year average annual return sits at 7.75%, and their 10-year average dips to 5.51%.
Oh.
So there's definitely some volatility there, and you
yeah.
need to weigh that against the potential growth of their alternative
It
products.
sounds like Altria is a bit of a gamble,
Yeah.
but potentially a high reward one if those new products take off.
Right.
Now let's move on to Chevron.
Right.
They've had some ups and downs lately with fluctuating oil prices, but their dividend remains pretty generous at 4.3%. What makes them stand out to you in the energy sector?
Well, Chevron is interesting because they've consistently increased their dividend payout,
Okay.
going from $4.32 per share in 2017 to $6.52 most recently.
Wow.
They're committed to rewarding their shareholders even when the energy market throws curveballs.
Yeah, but like you said, oil prices could be unpredictable, and that definitely adds an element of risk to the investment.
It does.
It's like riding a roller coaster, hoping for the thrill of high returns, but knowing there might be some dips along the way.
Yeah.
So for someone who's concerned about the environmental impact of fossil fuels, even with that tempting dividend, Chevron might not align with their values. Right?
That's a great point. Investing isn't just about numbers and potential profits.
Yeah.
It's about supporting businesses that align with your personal beliefs and ethical considerations.
Now let's switch gears to a company we all interact with regularly,
Okay.
Verizon.
Mm-hmm.
They offer a really attractive 6.5% dividend yield.
Nice.
But I understand there's more to the story, right?
Well, yeah, that high yield is partly because their stock price has been down in recent years.
Oh.
They've been facing challenges boosting revenue. However, they are investing heavily in expanding their 5G network, which could be a smart move for the future.
They're laying the groundwork for future growth, even if the present is a little shaky.
Yeah.
But the article also mentioned considerable debt,
Right.
which always makes me a bit nervous as an investor. Is that something to be concerned about with Verizon?
It's definitely something to factor in. However, Verizon generates a lot of free cash flow, which means they have money coming in that can be used for dividends, paying down debt, and investing in that 5G growth we talked about. So it's a bit of a balancing act.
Yeah.
But they could still offer a decent stream of passive income for investors.
All right, let's move on to a company known for innovation and helping us feel better.
Okay.
AbbVie, the pharmaceutical giant,
Uh-huh.
their 5-year and 10-year average annual returns look really impressive.
They do.
23.17% and 14.45% respectively.
Wow.
What's driving that success?
Well, AbbVie has been a strong performer thanks to their blockbuster drug Humira.
Okay.
However, they've also been hit by patent expirations on that drug, which means other companies can now produce generic versions, cutting into AbbVie's profits.
That sounds like a potential risk for future growth.
It is.
They'll need to come up with new blockbuster drugs to maintain that level of performance, right?
Exactly. It's like a hit song for a musician.
Yeah.
You need to keep creating new hits to stay relevant.
Yeah.
Fortunately, AbbVie does have other promising drugs in their pipeline, so they're working on generating their next big success story.
That's reassuring to hear.
Yeah.
But I remember you mentioned their payout ratio is above 100%.
Yes.
Which isn't ideal. Can you explain why that's a concern for potential investors?
Sure.
What does that really mean?
Think of it like this. Imagine you're spending more money each month than you're earning.
Okay.
Eventually, you'd have to dip into your savings or go into debt, right?
Yeah.
That's essentially what AbbVie is doing with a payout ratio above 100%.
Ah.
They're paying out more in dividends than they're currently earning. Now, they might have reserves to cover this for a while, but it's not a sustainable strategy in the long run.
So it's a red flag that they might be overstretched. Just something you definitely want to investigate further before investing.
Right.
Yeah, last but not least, let's talk about Realty Income, the REIT. That's like the reliable landlord of the stock market.
Okay.
They own over 15,000 properties across various industries and are required to pay out most of their earnings as dividends.
Wow.
Plus, they pay monthly.
Yeah, Realty Income is a popular choice for income-focused investors.
Yeah.
Those monthly dividends can feel like a regular paycheck, and because they own such a diverse range of properties,
Right.
from retail spaces to industrial buildings, they offer built-in diversification.
It's like having a slice of the entire real estate pie.
Aha, exactly.
But their 5-year average annual return is negative,
Yeah,
which is a bit concerning.
it is a little bit.
Should investors be worried about that?
Their recent performance hasn't been stellar. That's true, and because they're heavily tied to the real estate market, which can be cyclical, their returns can fluctuate. Remember, what goes up must come down, and vice versa.
Yeah.
But for investors seeking steady income and diversification, Realty Income might still be worth considering, especially if they believe in the long-term potential of the real estate market.
So it all comes down to your individual risk tolerance and investment goals.
Yeah.
Are you looking for high growth potential even with some volatility? Or are you more focused on that steady income and stability?
You hit the nail on the head. It's about finding investments that match not only your financial goals, but also your comfort level with risk.
For sure.
Yeah.
Okay.
All right.
So we've covered 5 individual stocks, some with tempting yields, others with impressive growth. But to be honest, I'm feeling a little overwhelmed.
Yeah.
It's a lot to process. And picking individual stocks can feel intimidating, even for someone who's been following the market for a while.
I understand completely. There are so many factors to consider with individual stocks. It's like trying to choose from a menu with endless options.
Right.
But fortunately, there's a simpler way to get exposure to dividend-paying companies
Okay.
without having to analyze each one individually.
You're talking about ETFs, right?
Exactly.
Those diversified bundles of stocks that offer a more hands-off approach to investing.
Imagine you're building a house.
Okay.
Instead of using just bricks, you use a mix of bricks, wood, and concrete that makes your house stronger and more resilient, right? ETFs are similar. They give you that mix of stocks, which can help your portfolio weather market ups and downs. And when it comes to dividends, there are ETFs specifically designed to hold companies that are known for sharing their profits with investors.
It's like having a team of experts picking out the best dividend-paying companies for you, and you get to benefit from their collective wisdom.
Exactly.
And conveniently, this article lists a few ETFs that focus on those dividend-flush companies.
Perfect. Let's take a look.
Okay.
We have the SPDR portfolio, S&P 500, high dividend ETF, ticker symbol SPYD.
Okay.
Then there's the Schwab U.S. Dividend Equity ETF, or SCHD, and the iShares Core Dividend Growth ETF, DGRO. And lastly, we have the Vanguard Dividend Appreciation ETF, known as VIG.
Wow, that's a lot of acronyms.
Yeah.
But seriously, how do you choose between them?
Yeah.
They all seem to be in the same general space.
They are, but they each have their own unique approach and criteria for selecting companies.
Yeah.
For instance, SPYD focuses on the highest yielding companies in the S&P 500. Think of them as the rock stars of the dividend world. They might not all have staying power, but they're putting on a great show right now.
So if you're looking for the highest immediate income, SDYD might catch your eye with that big yield.
Exactly.
But what about SCHD? What makes them different?
Well, SCHD leans towards companies with a history of consistent dividend growth.
Okay.
They're like those slow and steady tortoises we talked about earlier. They might not have the highest yields right now, but they've proven they can increase those payouts over time, which can be a great sign of long-term stability and profitability.
So if you're playing the long game and believe in consistent dividend growth, SCHD with its 12.02% 10-year return might be more your style.
Right.
It's all about what fits your investment personality.
Exactly.
Now, what about DGRO and VIG? How do they stack up?
Okay, so DGRO, the iShares Core Dividend Growth ETF, also emphasizes dividend growth,
Okay.
but they're even more selective. They specifically look for companies with a really strong track record of increasing their dividends over time. Like those companies that have been raising their payouts year after year without fail.
It's like they're looking for the valedictorians of the dividend world.
Haha.
With companies with a proven track record of excellence.
Exactly. Now, VIG, the Vanguard Dividend Appreciation ETF, has a slightly different approach.
Okay.
They focus on companies that are expected to increase their dividends in the future. They're looking for those companies with strong growth potential, the ones that are likely to become the dividend superstars of tomorrow.
So it's a bit more forward-looking.
Yes.
Betting on those companies that are poised for success. It's like investing in a promising young athlete before they become a household name.
Yeah.
Now, I know past performance doesn't guarantee future results, but looking at the historical returns of these ETFs can give us some insights, right?
Absolutely. Let's take a peek at those numbers.
Okay.
As of October 22nd, 2024, SPYD had the highest recent yield at 4.18%.
Wow.
But their 10-year average annual return isn't available since the fund is relatively new.
Oh, okay.
It's like a new kid on the block. It's got a lot of buzz, but we need more time to see how they perform in the long run.
Makes sense. Now, what about SCHD, DGRO, and VIG?
Okay, so SCHD boasts a 3.61% yield and a solid 12.02% 10-year return.
Okay.
They've shown consistent growth over time, which can be reassuring for investors. DGRO comes in at a 2.24% yield with the 12.49% 10-year return, proving their strategy of focusing on companies with strong dividend growth histories can pay off. And finally, VIG has a 1.65% yield and a 12.33% 10-year return, demonstrating that betting on future dividend growth can also be a successful strategy.
So even within the world of dividend-focused ETFs, we see a range of yields and returns.
We do.
It really highlights the importance of understanding the nuances of each fund before investing.
Absolutely. It's crucial to do your research and choose an ETF that aligns with your investment goals, your risk tolerance, and your time horizon.
Right?
Are you looking for immediate income long-term growth or a balance of both?
Like choosing the right tool for the job.
Yeah.
You wouldn't use a hammer to screw in a light bulb, right? You need to select the investment that fits your specific needs and objectives.
And remember, diversification is key. Whether you're choosing individual stocks or ETFs, spreading your investments across different sectors and companies can help reduce your overall risk.
Wow. It's amazing how many options are out there for investors.
It is.
You know who want to build wealth with dividends.
Mm-hmm.
We've gone from individual stocks to ETFs. And it's clear there's no one-size-fits-all approach.
Right.
It all comes down to, your personal preferences and financial goals.
It really does. Investing is a journey, not a destination.
Yeah.
It's about finding what works best for you and your unique circumstances. And remember, this deep dive is just the beginning.
It's like we've opened up a whole treasure chest of possibilities.
We have.
But before we wrap up, there's one question that keeps coming back to me.
Okay.
We've talked about yields, returns, diversification.
Mm-hmm.
But we haven't touched on ESG factors.
Right.
Those environmental, social, and governance considerations that are becoming increasingly important to investors.
Yeah, that's a crucial point.
Yeah.
ESG factors are no longer just a niche interest for investors. They're becoming mainstream as more and more people want their portfolios to reflect their values.
It's like wanting to invest in companies that are not only profitable, but also doing good in the world.
Precisely. For example, if you're passionate about renewable energy, you might choose to invest in companies that are leading the way in solar or wind power,
Okay.
even if their dividends aren't the highest right now.
Right.
Or if you're concerned about social justice issues, you might seek out companies with strong track records of diversity and inclusion.
So it's about finding that sweet spot where your financial goals intersect with your personal values.
Yeah.
It's like investing with your heart and your head.
And remember, every investment decision you make is a vote for the kind of world you want to see.
That's a powerful way to think about it. So to our listeners, as you continue your own dividend adventures, we encourage you to consider those ESG factors.
Definitely.
Do those high-yielding companies also align with your ethical compass? It's something to ponder as you build your portfolio.
Remember, investing isn't just about numbers and returns. It's about participating in the economy, supporting businesses you believe in, and shaping the future you want to create.
What a fantastic reminder. And on that note, we'll leave you to your own financial explorations.
Happy investing.
Until next time, keep diving deep and happy investing.